Before every financial crash, the tales echo the same refrain. This time is different. Euphoria and optimism disguise the slow buildup of vulnerabilities, leading to an inevitable downfall. The unsettling narrative quietly unfolds. 1. A compelling story gains sweeping consensus. 2. Liquidity makes that story shine, creating an aura of genius amidst growing fragility. 3. Leverage amplifies the fantasy, pulling more into the web of false security. 4. Fragile collateral creeps into the system unnoticed at first. 5. Cracks in the narrative begin to show, but remain ignored for far too long. 6. Then a catalyst strikes, sending shockwaves through the facade. 7. Margin calls and forced selling trigger a swift descent into chaos. 8. Policy pivots emerge, often too late to alter the course of destruction. 9. Post-crash narratives emerge, suggesting a state of shock and disbelief. As we approach 2025, the cycle looms with chilling similarities and unsettling innovations, woven into the fabric of a new narrative. AI will save everything. In 1937, after the worst of the Great Depression seemed over, policymakers tightened measures too soon, causing a stalling recovery. This teaches us that policy timing is crucial and that the economy experiences long lags. Fast forward to the 2020s, where one of the most aggressive tightening cycles in modern history battles inflation. Even if interest rates stop rising, the lingering impact continues to affect balance sheets for quarters to come. The aftermath of refinancing walls, commercial real estate maturities, and local budgets struggling with high yields demonstrate the far-reaching effects of economic policy. The energy shock and inflation of 1973-74 forced policymakers to choose between growth and rising prices. A tight monetary policy can be a brutal cocktail for risk assets, highlighting the fragility of low-rate forever thinking. In 1987, Black Monday showcased that market structure intertwined with leverage can lead to disastrous outcomes. The illusion of stability can disappear suddenly, leaving behind the remnants of a shattered financial landscape. By the late 1990s, crises like the Asian financial crisis and the failures of major hedge funds showed the dangers of interconnected global markets. Today, we inherit fragile global financial ties filled with emerging market debt and policy divergences. In the year 2000, eyeballs were seen as collateral, promising a beautiful future through technology. The story was about a future that, while bright, became catastrophic as metrics became detached from profitability. By 2008, the focus shifted to housing, where collateral chains and mortgage derivatives unraveled with a market downturn. This led to the grim realization that lending was often against nothing but air. As we moved to 2010-2012, even government debt was no longer risk-free, creating a vicious loop of demand and rising yields. By 2015-2016, China's economic shifts sent shockwaves through global markets, reminding us of interdependence. The pandemic in 2020 revealed vulnerabilities, with lightning-fast crashes and unprecedented liquidity challenges. Ultimately, quick policies rearrange problems, indicating that instability remains just beneath the surface. Let's condense a century into 9 repeatable signals that precede market crashes. If you catch 3 or more at once, risk is rising. 5 or more? Start thinking defensively. The first signal is when a dominant story turns sacred. When productivity miracle, or AI, will eliminate cycles, become common mantras, pushback is considered taboo. The second signal is liquidity mass fragility. Abundant credit and easy financing lead to rising prices and increasing leverage. The third signal is when leverage goes from smart to inevitable. Corporates and households optimize capital structures only to hide hidden leverage. The fourth signal is when collateral quality quietly deteriorates. Covenant-light loans and stretch valuations reflect a serious underlying risk. The fifth signal is concentration and crowding among mega-caps leading indices. Passive flows chase winners, clustering, carry trades in the same places. The sixth signal is policy, complacency, or constraint. Policymakers believe they can always do more until reality restricts them. The seventh signal is divergent macro signals, where strong headlines hide weak breadth. Strong employment exists alongside falling hours and weak sentiment. The eighth signal is when credit starts to sniff trouble. Watch high-yield spreads, default cycles, and refinancing walls. The ninth signal involves narrative cracks and shrugged-off warnings. A blow-up in a corner market can send shockwaves through the entire system, and sometimes markets will shrug until they don't. Mapping the pattern onto 2025 reveals a landscape where brutal honesty reigns, not doom, but a calculated view of probabilities. The sacred story for this year is AI, credible and transformative, yet at risk of overpricing. Markets often assume everyone will win, pushing profits forward while ignoring adoption curves and enterprise integration lags. Meanwhile, AI-adjacent capital expenditures could swing cyclically, showcasing the volatility that hides beneath the surface. Even when central banks pause, liquidity tightens, revealing underlying tensions in the market. Corporate leverage seems manageable until debt is marked against current yields amidst slow growth. The slow burn of commercial real estate reveals structural changes that cannot be ignored. Index concentration poses a fragility risk. When leadership narrows to megacaps, the market's stability is threatened. Government debt rises, limiting fiscal policy space and creating difficult trade-offs. Amidst this complexity, growth pockets diverge, presenting contradictory narratives across sectors. Finally, watch for cracks in the narrative, a decade of cheap money clashing with the new costs of capital. The unique 2025 cocktail showcases alarming economic trends that intertwine our future. First, AI emerges not merely as technology, but as a critical balance sheet variable. The pressures of government debt and rising servicing costs reveal the fragility of fiscal space. The commercial real estate reset signals a profound shift in work patterns and valuations. Liquidity plumbing is now modern, yet remains perilously risky and shallow. Geopolitical fragmentation introduces volatility into our supply chains, drastically altering the landscape. Demographics with aging populations add complexity to savings and consumption patterns. Finally, climate risks escalate, impacting insurance and commodity pricing on a global scale. The conclusion of this cocktail reveals the potential for a classic crash, exacerbated by modern amplifiers. While we may not foresee crashes, understanding the true complexity of our economic narratives is vital. The antidote lies in a disciplined process of tracking the fundamentals rather than being swayed by fleeting headlines. The early warning dashboard highlights 12 dials that signal impending market crashes. You don't need perfect numbers, just trend and direction to predict the future. Credit spreads indicate when the party's over before equities acknowledge it. The yield curve's inversions signal caution, but rising long rates can be just as deadly. Monitoring refinancing walls helps manage concentrated risks in real estate and credit. Earnings quality concerns arise when buybacks mask thinner cash flows. A narrow breadth of the equity rally indicates fragility in the market. Tighter bank lending standards slow future spending and economic growth. Rising collateral haircuts can trigger sudden de-risking in financial systems. Watch short-term funding markets for strains as they signal trouble before headlines reach the public. Spiking hedging costs lead to retreats from foreign buyers, forcing local yields to rise. Occupancy drops and lease expiries gradually reset property valuations. Commodity price spikes induce inflation fears and strain policy support. Policymakers face daunting choices amidst inflation and deficits, leading to bigger market drawdowns. No single dial can call the top, but clusters of deterioration act as your smoke alarm. The 2025 crash scenarios are not predictions. They are pathways, framed like if-then trees. In scenario A, the slow squeeze leads to a snap. AI optimism keeps megacaps elevated, masking the weak breath beneath the surface. As credit quietly deteriorates, regional lenders announce larger-than-expected write-downs. High yield spreads jump, liquidity thins, revealing fractures within the system. One large AI-adjacent CapEx project faces delays as the market realizes its previous assumptions were flawed. Forced de-risking cascades through options and passive flows amidst fears of reigniting inflation. The outcome of scenario A may lead to a 20-35% equity drawdown, with credit leading the decline and CRE emerging as the grinding pain. In scenario B, a bond market revolt emerges as fiscal deficits widen and issuance ramps up. Rising term premia cause long yields to surge without accompanying growth, putting pressure on equities. Interest expenses climb, hindering spending and reducing growth expectations. The safe asset paradoxically becomes the problem. Scenario C unfolds with a geopolitical shock and energy spike, disrupting shipping and energy supplies. Inflation expectations rise while policy responses stay tight, leading to margin and valuation compression. In scenario D, China faces contagion as policy support underwhelms and property woes deepen. Global growth expectations slip, pressing credit and commodity exporters against the wall. As risk-off sentiment hits global equities, the USD tightens financial conditions across borders. The outcome is global de-risking. Keep an eye on corporations sensitive to China's economic fluctuations. In scenario E, the AI adoption gap grows as costs hit now, while savings take time to manifest. Power constraints delay deployments, with regulators adding friction to progress. Although AI-themed revenues are real, they often fall short of expectations, compressing multiples significantly. This leads to a correction in index leadership, prompting a broader market shift towards quality cash flow assets. Many investors mistake price stability for system stability, setting the stage for disastrous decisions. They overlook the dangers of overpricing a compelling story, believing it to be immune to market forces. Overestimating policy omnipotence creates false confidence during uncertain times. Investors often ignore credit markets, drawn in by the allure of equities, neglecting crucial indicators. Planning to be nimble during a market downturn often leads to miscalculations and missed opportunities. The 20 to 25 Investors Checklist offers a stark reality check for those navigating potentially treacherous waters. Are spreads widening? Has leadership narrowed to just a few stocks? The signs are clear. As credit stress weighs heavily, maintaining awareness and checking off more indicators becomes vital. Recognizing that this time is different is a trap that can lead to weakened defenses. Ultimately, a crash is preceded by a sacred narrative, transforming liquidity and leverage into perilous tools. It's not just about predicting the catalyst, but understanding the patterns and de-risking before the storm hits. In the before, survival hinges on respecting cycles and knowing when to hold cash as uncertainty looms. As we enter 2025, navigate with awareness of AI as the sacred story, government debt as the weight, and emerging pressures in commercial real estate. You can't time earthquakes, but you can build resilience in a world of uncertainty